Good morning and welcome to Swissquote's Daily Market Talk. It's Monday, November 4th. We are just a few hours away from the US election results, the next FOMC decision, the BOE verdict, and a couple of more earnings from big international names. So yes, we are heading into a potentially pivotal week for global markets. So tune in. We have a lot to cover this Monday morning. So last week was a big week packed with earnings where 5 of the Magnificent 7 stocks will announce magnificent earnings in the third quarter, but some of them, like Google and Amazon for example, managed to keep their investors on their side, whereas others like Microsoft and Facebook's Meta failed to impress their investors as well. They couldn't really get over the weaker forecast for the next quarters in terms of AI revenues and further AI spending respectively that they announced. And Big Oil announced lower profits in the third quarter, but share buybacks and higher dividends at some of them, like Exxon for example, helped weathering the bad news there. Then, the US GDP growth came in slightly lower than expected by analysts at 2.8%, remember, for the third quarter, but the consumer spending in the US remained very robust indeed. And finally, on Friday, the US announced its official jobs data, where we could actually discover the damage that the two hurricanes and also the strike at Boeing had on hiring in the US. So in numbers, the US economy ended up adding a meager 12,000 jobs last month. Yes, I also thought that they might have forgotten a zero in that non-farm payrolls number when they announced it on Friday, but no, that's the official number. The US economy added 12,000 new non-farm jobs last month in the US, and the manufacturing and private payrolls printed a negative number, both of them. But the bright spot in that was that unemployment in the US remained steady at 4.1%, suggesting that the NFP number that we saw last Friday probably was a one-off hit, and the wages in the US continued to grow by 4% on a yearly basis. So that's a bit high compared to where the US Federal Reserve would like to see it, but it's still well aligned with the market expectations. So, as a result, the market is now pretty much convinced that the Fed will announce another 25 base point cut when it meets this week. So that announcement is due on Thursday this week, however, and not on Wednesday, as before that we have the US election on Tuesday. So let's see what happens. But anyway, looking at the data and the market, Friday's NFP figure didn't necessarily bring a relevant information on the table. So the S&P 500, Nasdaq 100, and the Dow Jones Industrial Index were better bid on Friday. But all of these three indices closed last week on a negative note. Then the US 2-year yield consolidated around 4.20% level, and the 10-year yield around 4.30% mark after the jobs release this morning. Both of the yields are pushing higher, especially the 10-year yield, which spiked to 4.38% in Asia this morning as investors around the world are closing their US Treasury positions before the US election. And yes, ladies and gentlemen, we are finally there. The clock is ticking, and soon the suspense will break over who will win the next presidential election in the US. Now, even though the prediction markets have gone absolutely crazy betting in favor of Donald Trump, the CNN poll this morning prints a 48% chance for a Harris win versus 47% assessed to a Trump victory. Now, the worst possible outcome for the election would be a too close to call result and, a contested outcome, but both candidates are, expected to contribute to a further ballooning of the US debt, Harris by increasing spending and Donald Trump by cutting taxes. But besides that, the economic and political agenda of both candidates is sensibly different from each other, and that's important for the market. And we talked about it in detail about the election outcomes and the market reaction to it with NFG partners Nick Bedford last week. So I invite you to watch our special US election edition on our YouTube channel if you haven't done so just yet. So in the short run, well, a Harris victory is expected to bring some relief rally to, well, US treasuries and international markets, while a Donald Trump victory could actually resonate higher and louder, and not necessarily in a good way for especially the euro and the European markets. As obviously, as we have been talking about it for so long, the EU could be immediately hit by the fear of sizable tariffs on European companies, and that would weigh on the European company valuations that are already in a trouble. So the Stoxx 600 index had, well, quite a good rebound on Friday's trading session, but the index could eventually bear the brunt of a potentially Trump victory a bit later this week. Now, all that being said, another place that actually immediately comes to our mind is obviously China when we talk about Donald Trump. So the Chinese equities actually started the week on a bullish note as the National People's Congress in China began its 5-day meeting today, where the Chinese policymakers are expected to provide some more details on debts and their fiscal initiatives to revive growth in China. Now, there are media reports out there suggesting that China may actually announce a stimulus package exceeding 10 trillion yuan to boost the Chinese economy. Now, I can't really tell you what amount of stimulus China could be announcing this week, if they, well, put any number on it at all. But the expectation is that a Donald Trump presidency in the US could increase the size of a package, whatever it was in the beginning in Chinese policymakers' minds, and provide a safety net to Chinese investors in case of a Donald Trump win. And the FX markets, while the US dollar kicks off the new week on a bearish note, the index slid below its 200-day moving average in Asia. The euro dollar is testing the 109 resistance to the upside at the time of talking, and even cable, which has been pressured by last week's budget shenanigans in the UK, has jumped to flirt with the 1.30 psychological resistance this morning in Asia. Now, one of the safest harbors in the market is obviously gold before the election, which looks bid this morning near an all-time high level that was reached last week. The Swiss franc and the Swiss equity index are also seen as quite interesting defensive names in preparation of a potentially contested US election outcome this week and a heightened short-term volatility as a result of it. So the dollar franc has been testing an important Fibonacci resistance lately, the major 38.2% retracement on May to September sell-off, and which should eventually determine whether the pair should remain in its actual bearish trend or step into a medium-term bullish consolidation zone. Now, data-wise, last week's softer than expected inflation numbers from Switzerland and softer than expected retail sales data came to reinforce the dovish SMB expectations, but that crucial Fibonacci resistance hasn't been pulled out. And while the dollar franc bulls may have to wait a little bit longer until the US election does settle to continue betting in favor of a weaker Swiss franc. For the Swiss equities, well, Swiss market index is heavy in healthcare, pharmaceuticals, consumer staples, and financials, with a good amount of private wealth management in Switzerland that brings stable revenues to the financial institutions. As such, well, the SMI could weather the market volatility a bit better than its major international peers, as the VIX index, for example, is warning that tension among the big US stock investors is mounting these days ahead of the US election. So Swiss markets could be an interesting place to, well, seek some safety. Elsewhere, oil kicked off the week better a bit on weekend news that OPEC could delay the planned December increase to oil production by, well, a month or more than a month on the back of this persistent sell-off that we see in oil prices, which is due to the unfavorable combination of weaker global demand, and strong output prospects from the non-OPEC producers. So the Middle East rumors also hint at a possible revival of the geopolitical tensions between Iran and Israel, a factor that could also help bring some tactical long positions back to the oil markets this week. But price rallies that we might see in oil are still considered as being interesting top-selling opportunities for the bears as long as the gap between demand and supply outlook widens. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.